Something strange is unfolding in markets right now. A setup that looks exactly like 1999, only this time the engine's running on debt, deficits, and zero real rates. Back then, pure optimism sent prices vertical. Today, that optimism has a fuel source. Governments printing trillions, central banks turning dovish, and investors scrambling not to miss the next wave. Every bubble needs a story, and this one has plenty. Artificial intelligence, rate cuts, endless liquidity, all colliding in a single moment where money feels infinite again. But beneath the surface, this isn't just another rally. It's something much larger. A global liquidity surge slamming into a monetary system that's running out of trustworthy assets.
Well, it's like the Prince song. It's 1999. Party like it's 1999, right? Feels exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place. And certainly from a trading standpoint, you have to position yourself like it's October 99. I don't see why you would do anything but that. And remember, the NASDAQ doubled between the first week of October 99 and March of 2000. So if it looks like a duck and quacks like a duck, it's probably not a chicken, right?
When a man who predicted the 1987 crash says conditions today are more explosive than the dot-com bubble, it's worth listening. Jones isn't warning about frothy tech stocks. He's describing the same ingredients that have fueled every historical blow-off: cheap money, moral hazard, and blind faith in the Federal Reserve. Only this time, that same monetary firestorm is colliding with an asset that can't be printed. But before we continue, if you enjoy deep dives like this, make sure to check out our free daily email, Crypto Nutshell. Tens of thousands of investors already rely on it every morning for the biggest stories, sharpest predictions, and on-chain data that actually matters. First link in the description. Now, let's get into the video. For decades, liquidity has felt infinite, conjured from debt, leverage, and political promises. Every bailout, every round of quantitative easing, every fiscal rescue, another injection of artificial stability. But Bitcoin broke that loop. It introduced absolute scarcity, a system that doesn't bend to politics, deficits, or central bank emergencies. A network where the rules are written in code, not negotiated in conference rooms. The old world runs on credit. The new world runs on math.
You look at what's traded on the Forex on a daily basis, it's circa $7 trillion of trading. That'd be 100 to 1,000 times bigger than the daily trading volume of Bitcoin. All of that trading is going to migrate to Bitcoin at some point in time. And this is, on a really rudimentary basis. I look at this and I think, when there's absolute digital scarcity, when no Bitcoin is for sale and we have credit markets that are enabling anyone who wants to never sell their Bitcoin, we then get to a point in time when we achieve full hyper-Bitcoinization that no one in their right mind who's basically selling a good or service will take anything other than Bitcoin for that. And I look at this and I think today, in today's numbers, not to mention the inflation that's to come and the productivity boom that we're going to see with AI and all the other numbers that, basically show that this number will grow significantly over the next 10 to 20 years. We've got $7 trillion of daily global trade, and we've only got 450 Bitcoin minted on the day. By my logic, if we've got all of that Bitcoin tucked away that no one's selling, we need to facilitate $7 trillion worth of transactions on a daily basis with whatever's minted on the day. And so I look at that and think, this is where things are going to become surreal, because there's no way of really, and this is where, friend of the show and friend of mine, Jeff Booth, I think he's got the greatest outlook on it. You can't measure the new system from within because it's a completely different paradigm. We can talk about numbers all we want, but it's going to look completely different to what we think. All I can tell you is that number's going to go up significantly more than we think.
Think about that. $7 trillion move through global trade and FX markets every single day, and only a few hundred new Bitcoins are created to meet it. That's not a market. That's a pressure cooker. Every halving tightens the valve. Every cycle shrinks what's left. And when demand collides with that kind of scarcity, the result isn't subtle. The price has to rise. And as Peter explained, Bitcoin credit markets will soon allow value to move without coins constantly changing hands. That means trillions in daily transactions can flow through the network while the underlying supply barely moves. Liquidity circulates, but the base layer stays locked. Over time, that dynamic creates a feedback loop. The more infrastructure that builds on top of Bitcoin, the fewer coins ever reach the market. Less selling, tighter supply. A financial system that gets stronger, not weaker, the longer people hold.
And the beauty of Bitcoin is the very simple story. They are never going to stop printing money, so therefore Bitcoin will never stop going up. And if you simply think of Bitcoin as savings technology, all you have to do is go out, work hard at your job, make money, spend less than you make, and then put the extra savings into Bitcoin, and then allow Bitcoin to benefit from what we know is going to happen, which is they are never going to stop printing money. And I think that simplicity is actually very attractive to some cohort of investors. And now you see investors saying, wait a second here, this quote unquote debasement trade means that I don't have to go do all that work. I can simply just go and buy something like Bitcoin. And I think that really maybe the story of finance of this decade is that Bitcoin is becoming the hurdle rate, right? Historically, we've looked at things like the S&P. If you go back to 2020, the S&P is up 100% since 2020. Priced in Bitcoin is down 90%. All of the returns that people are talking about in traditional finance, most of them are negative because no one can beat Bitcoin. And so if you can't beat it, then we just say you got to buy it. And I think that's what a lot of investors are starting to do.
Pompliano's point cuts right through the noise. Traditional finance forces you to track 1,000 moving parts: earnings, rates, politics, quarterly forecasts. Bitcoin doesn't care. It's not a trade. It's a savings technology, a way to store the value of your time in something governments can't inflate away. You work, you save, you hold, and as the fiat world keeps debasing, Bitcoin quietly preserves what matters most: your time, your effort, your future. That's not speculation. That's survival. The macro backdrop feels hauntingly familiar, but this time it's supercharged. In 1999, the Fed was hiking into a euphoric market. Now it's cutting into one. Back then, America ran a budget surplus. Today, it's drowning in a record deficit, pouring fresh liquidity onto already overheated markets. The system that once tried to fight bubbles now depends on them to survive. Debt isn't a risk anymore. It's the business model, and every new rescue only tightens the loop.
And my guess is that I think all the ingredients are in place for some kind of a blow-off. Will it happen? Again, history rhymes a lot, so I would think some version of it is going to happen again.
Right.
If anything now is so much more potentially explosive than 1999. 1999, we were looking at a rate hike in November. Now we're looking at a rate cut. We were looking at 4 more rate hikes before we actually topped in 2000. Now we're looking at 3 or 4 rate cuts, probably at least. So you have monetary policy that's going to take us to real rates of 0 or less, probably, depending upon the next Fed chair. And then the big difference is, obviously, fiscal policy. We had a budget surplus in 99, 2000. Now we've got a 6% budget deficit. So that combination, that fiscal monetary combination, is a brew that we haven't seen since, I guess, the post-war period, early 50s, something like that. And that was crazy times, right, coming out of the war.
Jones is describing the oldest story in finance, the script behind every inflationary boom in history: loose money, moral hazard, and investors sprinting toward anything that feels scarce. But this time, the story has a new protagonist: Bitcoin. It's not tied to productivity, politics, or promises. It's tied to time itself, a fixed supply asset running on the world's most secure ledger. And that changes everything. Investors aren't measuring success in dollars anymore. They're measuring it in Bitcoin. And when you do, almost every traditional asset looks like it's standing still. The question is no longer, can I beat Bitcoin? It's why even try? Bitcoin isn't just outperforming the system. It's quietly becoming the yardstick by which the system is measured. Every revolution starts quietly from the inside. For Bitcoin, the next wave of adoption won't come from retail traders or even ETFs. It'll come from corporate balance sheets, the Trojan horse of mass onboarding. The moment public companies begin holding Bitcoin as a core asset, they drag the entire financial system in with them.
Well, this is not going to be popular with the Bitcoiners. But I think we are going to have a Trojan horse with Bitcoin adoption, and it will come through the treasury companies. If Sail is included into the S&P 500, then every pension fund in the US is going to have that, whether they like it or not. So technically that would mean greater adoption than the spot Bitcoin owners. But I think this is a Trojan horse that basically puts another layer at the top of the funnel. They invest in this. They now all of a sudden have skin in the game, and then that's the impetus to basically learn about Bitcoin. And as we all learn about Bitcoin, we move gradually deeper down that rabbit hole, that we go from wanting some paper Bitcoin exposure, whether it's an ETF or through strategy. And then once you understand that, you realize, hang on a second, there's actually some really good things about this that is not just about number go up. There's actually some freedom go up technology to this too that I would like to have some control over. So I think it starts there. That's the broadest mass appeal that we can have, because that's the least friction to onboarding people into Bitcoin. And then once people learn about it, they then descend down the rabbit hole and turn into spot Bitcoin buyers.
That's the hidden genius of the treasury company model. When firms like MicroStrategy and the new generation of Bitcoin treasuries enter major stock indices, exposure becomes automatic. Every pension, every 401k, every passive index fund suddenly owns a piece of Bitcoin, whether they know it or not. That's how hyper-Bitcoinization begins. Not through ideology, but through accounting. The legacy financial system becomes Bitcoin's distribution network, line by line, spreadsheet by spreadsheet. And once that happens, the game flips. Exposure comes first. Education follows. Curiosity turns into conviction, and conviction turns into self-custody.
But what you see is more and more Bitcoin is being taken into what we call illiquid supply. So over time, that percentage continues to increase, where every Bitcoin that I buy, no one's ever touching it again until I die. Right? And I think there's a lot of Bitcoiners who believe the exact same thing. And so what you're starting to see is that illiquid supply numbers creeping up. And so as more capital comes in, the only thing that can happen is if you have a finite supply asset, more people want that asset, but the people who hold it aren't willing to sell it, the price has to go up to clear the market. And that's why Bitcoin continues to go up over time.
Meanwhile, the math tightens. Illiquid supply keeps climbing. Institutional demand compounds. And because Bitcoin's supply can't expand to meet it, the system begins to self-reinforce, a structural short squeeze on fiat itself. Every new buyer locks the next one higher. Every new holder makes the system stronger. Now we enter the danger zone, the stage Paul Tudor Jones calls the juice. It's the euphoric final stretch where everything doubles before it cracks. The charts look unstoppable. Headlines scream new highs, and rational investors start chasing momentum just to keep up. But Jones isn't warning of an imminent crash. He's pointing to the explosive run-up that comes before it.
But you think it's 99, and we were talking to Mike Novogratz earlier today. It's not 98. I mean, everyone's it's either 98, 99, but it's not 96, I guess is the point.
Right.
And that's a problem, potentially.
Right.
Or it's maybe an opportunity, but you have to get on and off the train pretty quick.
Well, if you just think about bull markets, right, the greatest price appreciation is always the 12 months preceding the top. So that's the nature of a bull market. It kind of doubles whatever the annual average is and before then. So if you don't play it,
right,
you're missing out on the juice. If you do play it, you have to have really happy feet, because there will be a really, really bad end to it.
That's the paradox of every melt-up. You have to ride it to win, but move fast enough to survive the turn. Except this time, something fundamental has changed. Bitcoin holders don't need to sell. They can build, transact, and deploy capital on top of their holdings while keeping their base untouched. It's a structural shift from speculation to permanence, a financial system that compounds instead of leaks. The rails built around Bitcoin let liquidity recycle through the network rather than drain from it. Every holder becomes part of the infrastructure itself. This is how markets evolve, from trading instruments to monetary foundations, from chasing price to owning the system. Gold has protected wealth for thousands of years. Empires rose and fell around it. But in a digital world moving at the speed of light, slow money loses. The old store of value still matters. But now it's met its match, a competitor with wings.
Gold has done better than Bitcoin this year. Do you think in the crypto community they see gold as an ally, or is it a competitor?
Yeah, it's funny that on one hand, Bitcoin and crypto folks, they're brothers in arms, right, in the fight against currency debasement. On the other hand, I think that the gold bugs are having a field day because they're outperforming Bitcoin. I think gold's up 50% this year. Bitcoin's up about 33%. What I will say is that the average return since 2015 of Bitcoin in Q4 is 60%. So the gold bugs, you're not at the finish line for the year yet. Let's see what happens. But if you go back just 5 years, right, gold is up about 100%. And during that time, Bitcoin's up 1,000%. And so I think that they both benefit from the same thing. It's just that you have a smaller market cap asset that's got a lot more volatility in Bitcoin. And therefore, it's kind of gold with wings is the way I like to think about it.
I think what the markets are telling you, this is an inflation story down the road. If you look at the biggest winners, right, the biggest winners are gold. I think it's up 46, 47%. Bitcoin, I want to say it's up 50 or 60. I'm not even sure. There's a Morgan Stanley basket that's a retail flow basket that has all the meme stocks in it. It's up 67, 68%. So it's really what retail jumps on. So crypto, digital gold, that's obviously something that's very, very appealing.
And does that mean you're jumping on all of that right now?
Well, I'd want to have positions in all of it, for sure. So if you said to me, what are going to be the winners? Again, we have this race.
Right.
The race realistically is certainly to the end of the year, because that's when everyone marks institutionally. And then you have to figure out what's going to go on in next year. So what would I want to have? I'd want to have a combination of gold, crypto, probably the NASDAQ. I think, I want to say that I've said that before, and I think that's still the right one. And I think whatever the fastest horse is at this point in time probably has a good chance of being that on deck 31.
2 generations, same instinct, preserve purchasing power. Gold defends the past. Bitcoin monetizes the future. One is heavy, static, and bound by geography. The other is portable, divisible, and alive. Pure information secured by energy. Gold stores value. Bitcoin transmits it instantly, globally, and without permission. It's not just digital gold, it's monetary energy. The evolution of sound money for a networked age. The melt-up always rewards the reckless, right up until it doesn't. When the liquidity tide goes out, there's only one thing that truly matters: sovereignty. Because you can't be liquidated if you hold the collateral that underpins the entire system. Everything else is leverage, borrowed confidence waiting to be tested.
I think buying spot Bitcoin and owning that for, say, a minimum period of 8 years will give you a foundation of financial strength that you never knew possible. And a level of financial freedom that allows you to have full control over your assets and be completely in control of your future. I would start with spot Bitcoin, holding it for 8 years. Once you've got a base that is untouchable and you're completely unbreakable from a financial point of view, then I would go out the risk curve and look at something like strategy. Only once you're completely set up and impenetrable would I look at the other things. But the only caveat to that is, if you have capital that's stuck in a system that doesn't allow you to buy Bitcoin, then sure, the second best alternative, turns out there is a second best, and that is owning strategy shares.
That's the real divide between speculation and freedom. You don't need to chase every new narrative if you already own the foundation they're all built on. Bitcoin isn't a trade, it's an exit strategy. Sovereignty first, speculation later. Every cycle ends the same way, with euphoria. But this one's different. It's powered by fiscal steroids and absolute scarcity colliding at once. And when that energy finally converges on Bitcoin, it won't look like a bubble. It'll look like a repricing of money itself. If you want to catch the next signal before it's obvious, hit subscribe, and I'll see you all in the next one.